Good morning, everyone. Good afternoon, or possibly even good evening, depending on where you are in the world. And welcome to today's webinar, which is Property Under Pressure, Real Estate Risk in an Era of Geopolitical Conflict. I'm Olivia Dakin, and I'm the Research Principal at Themis. I work in our Insight team here. And hopefully you remember what you've signed up for. But just to refresh your memory, we're going to be exploring a subject today that really sits at the intersection of some of the most pressing risk issues that are facing financial institutions, compliance professionals and property markets right now. And that is the convergence of conflict, capital flows and financial crime. So these elements have always been linked, as I'm sure you're aware, that where there is conflict, capital moves, and where that capital is moving under pressure sort of quickly and covertly across borders, then the conditions for financial crime do tend to flourish and thrive. And real estate, with its opacity and its high transaction values and its really historic role as a store of wealth, does remain one of the most significant pressure points in that chain. But of course, what makes this moment particularly urgent is the situation that is unfolding around Iran. So beyond the human impact of that, the compliance and financial crime implications are really already being felt, and particularly when it comes to real estate and finance markets serving as conduits for funds that are linked to sanctioned states and individuals. So today we're going to unpack what this convergence actually looks like in practice and what it means for those of us who are working in regulated industries. So before we jump into it, I will introduce you to my esteemed panelists. Henry Wyard, first up, who is my colleague in the Insight team. He's a policy manager there, and he leads research programs with public sector clients, and he supports our team's risk intelligence, advisory, training and capacity building functions. He's led multiple projects for government partners on sanctions implementation challenges and circumvention typology, so is very well placed to talk to us today about this. He's recently been commissioned by the Council of Europe as an expert supporting EU reforms of AML standards as well. A riveting subject for all of us. And he's supported regulators developing policy responses to financial crime threats of all kinds, whether that's fraud, AI money laundering, and many, many more. So Henry will talk us through the macro risks and set the scene in terms of real estate and the financial crime risk that it poses. We'll then move on to Finlay Taylor, who will talk through some of the case studies and how sort of real estate risks and illicit funds are concealed in property transactions on a practical level. Finlay is an investigations analyst in our intelligence team. He's got a background studying political economy, international relations and history, and he's got a lot of past experience researching developing economies, and that's really led him to specialise on reports regarding jurisdictions in Africa, across the MENA region, Southeast Asia and the post-Soviet states. So Finlay's day-to-day is really conducting enhanced due diligence reports for our clients that identify financial crime and reputational risks. And he's really, through that work, become accustomed to identifying political connections and structures, particularly of corruption, in jurisdictions like Lebanon and Macau and Azerbaijan. But outside of his normal day-to-day job, Finlay also provides a lot of support to the marketing team. He's written articles and blogs on really interesting topics like the increasing prevalence of AI content connected to autocratic leaders or the use of global companies to hide the money trail of Colombian mercenaries in Sudan. And then last but not least, we'll have Melissa Sukera, who is a former MLRO for real estate businesses in Dubai. She's got extensive experience in developing AML, CFT frameworks, policies and procedures, as well as developing and delivering bespoke GRC training to senior management and employees across regulatory authorities and private sector firms. And she's got a particular strong focus there on DNFPBs in the UAE. She's ACAM certified. She's got an ICA diploma in governance, risk and compliance, and many, many more. So if you have any questions, we're going to disable the chat function. It's quite distracting sometimes when you're trying to talk and you see chats popping up, but you've got the Q&A function there for you. So if you have any questions throughout, you can pop them in there and we'll get to those at the end rather than during each session. But without further ado, I will hand over to Henry.
Thank you very much, Olivia, and good afternoon and good morning, everyone. I've overcome my first hurdle, which is finding the unmute button. So I hope that you can all hear me. So the theme of our discussion today is a very broad one. And in the next 10 minutes, what I want to do before I hand over to my colleagues to take us through the detail of what illicit finance risk and risk mitigation in the property market looks like in practice, I want to set out some historical context and some key trends that can help serve as a framework for this discussion. The first point is that you'll see that I'm discussing illicit finance rather than financial crime or transnational organised crime. That's not to say that those sort of obvious criminal activity risks are not pertinent in this discussion, but it's rather because that many of the risks that are faced from financial flows in a time of geopolitical conflict come not directly from activity that is obviously criminal, but rather from flows that to some jurisdictions' perspectives may be the results of legitimate economic activity, but to other jurisdictions represent the illegal evasion of sanctions or even the financing of terrorism. It's a key point of sort of definitional complexity that we really should bear in mind when we're discussing this topic. The final caveat is that there are a lot of themes that we won't be able to cover in detail in 10 minutes. So please do ask questions in the Q&A, or obviously get in touch with me or my colleagues afterwards if a separate conversation would be useful. But I want to start with what I think is a very interesting and useful vignette, which is the two buildings on the right of your screen. These are two buildings on the same street in New York City, built at about the same time, which have both been involved in very lengthy legal proceedings relating to illicit financial activity, and both, rather ironically, are associated with two of the main protagonists in the current US-Iran context. So on the left, we have Trump Tower, which has a very long and, depending on your perspective, glorious or inglorious history. A New York judge found that the Trump company was liable for fraud, for inflating the value of Trump Tower and its other properties for the sake of securing bank loans. But this really is a representative of the current US regime. And on the right, a building which really is only about 500 meters further up the same street is 650 Fifth Avenue. This building was originally constructed by a charitable foundation, a Bonyad, controlled by the former Shah of Iran. After the revolution, the new Iranian regime took over the foundation and created a partnership with a state-controlled bank, which was later sanctioned by the United States for financing Iran's weapons of mass destruction programs. US sanctions were imposed on Bank Melli, the bank that was controlling this building, in 1995. And at that point, a complex corporate structure was created in order to facilitate the payment of tens of millions of dollars from the rent of this building you see on the far right of your screen to the bank controlled by the government of Iran and ultimately to the government of Iran. That was began a very long legal proceeding, which finished actually this year, sort of a month ago, with an announcement of a settlement. But the reason why I start here, we don't have time to go into the details of these two cases right now, but the reason I start here is that these two buildings are a very useful lens for understanding illicit finance risk in property markets. So they show how, firstly, changes in political regimes can completely upend the nature of a particular transaction. So this building, 650 Fifth Avenue, when it was built, was an entirely legitimate and probably welcome investment by a foreign government. A huge geopolitical change, as in the 1979 Iranian Revolution, happens, and then suddenly this asset totally changes in its very nature, in its legal nature, in its political nature. And the second thing is that the international reach of commercial and investment networks within property markets mean that risk exposure can really travel very quickly across jurisdictions. So the heart of the US empire is certainly far from immune from risks relating, for example, to the regime of the current government in Iran. So I think that the final thing to highlight here is why these properties are attractive. And the attraction for legitimate investors is very similar to the attraction that they hold for illicit financial actors. So I think the key points to raise here are that real estate assets often, if not always, combine high value, a high level of asset stability compared to other high value products. If we think, for example, about luxury cars, they are very compact stores of a lot of worth, but frequently luxury cars are both firstly liable to damage or to seizure much more easily than a building is, and secondly, they're possibly more liable to depreciate. So a final thing is that buildings can have the ability to generate ongoing income, as we see in the case of 650 Fifth Avenue, a very useful continuing source of finance for the regime. And they also facilitate the conducting of complex transactions. So there's a very long history of risk relating to illicit financial activity in the property sector. And that is something that we should be very welcome for. It's very useful because it gives us a lot of material that we can draw on to understand the present situation and challenges within the present situation. So I want to underline 3 principles before we move on to look at some more cases. So the first is that illicit finance risk in property markets is very often, if not always, multi-jurisdictional. Secondly, the threat often emerges towards the end of a much longer laundering chain. So property assets are often not the start or a sort of early point along the money laundering flow. They often happen right at the end of a much longer illicit financial structure. And then thirdly, while illicit actors are adaptive, they are not mysterious. We do know a lot about how they've used property before, and therefore we can guess something about what they may do next. So when we come on to some key structural dynamics, I do not want to give the impression that illicit finance risk in the property market stems only from Iran, and that's very far from the case. So in the UK's 2025 National Risk Assessment for Money Laundering and Terrorist Financing, we see that property transactions appear across money laundering typologies and predicate offences across the board, including corruption, sanctions evasion, modern slavery and human trafficking, organised immigration crime, drugs trafficking and fraud. And there's an estimate, this is within a UK context, but many of these findings are applicable internationally, that up to £10 billion could be laundered through the UK property markets. And this is a point that the Financial Action Task Force repeats internationally, so that real estate remains attractive to criminal actors, to illicit financial actors, and the sector often shows a somewhat inadequate understanding of its own risks. So if we move to the next slide, I've got a few key dynamics that we can look at on the board. So the first key dynamic is the utility of property for illicit finance. So as I said, property is very often not the first step in the laundering process. Rather, it's an incredibly useful source of value holding. And there are certain factors about the property, the way that property investments work, the ability to have complex transactions, the ability to include lots of corporate structures within those transactions, that makes it somewhat more attractive or more possible to be able to enter those legitimate markets than would otherwise be the case. And so this brings us to the second key dynamic that I think is worth highlighting, which is around the obscurity of ownership and control. So Transparency International publishes an opacity in real estate ownership index, the Oreo index. I think it's quite likely that they changed the way that name was phrased in order to get a good acronym. And what they found is that globally, real estate frameworks do not have a watertight approach to transparency. In many places, national residents, but also foreign companies, do not have to declare their beneficial owners where they buy property. This is, of course, the question of beneficial ownership and ownership transparency is a complex one, but I think the point here is that it's not always, well, it's obvious who is buying it, well, it's obvious that a building is being developed or being constructed or being bought and sold. It's often not the case that it's clear exactly who is involved within that transaction. And that's all the more the case when we see the use of corporate structures, such as private investment vehicles and special purpose vehicles, to buy property, especially higher end and commercial property. There are, of course, very good business reasons to do that, so to pool capital, to outsource, to lay off risk, but there are also clear facilities that those vehicles have for illicit activity. The third key dynamic, where I say parastatal actors and privateers, is that the actors involved in international illicit state-backed financial activity do not always look like state actors. So the example here on the left of screen is Babak Morteza Zanjani, who was sanctioned years ago, I think over a decade ago, as a key facilitator for Iranian oil deals. He was sanctioned by the US Treasury for embezzling billions from Iran's national oil company, but he was essentially used as a key figure by the Iranian state to be able to construct corporate networks overseas. And why is this important? I think it's because the face of sanctions circumvention isn't necessarily a uniformed official. Quite often, it will be a very commercially plausible intermediary, a wealthy international, well-connected businessman who is superficially separate from the state and perhaps even says they are not affiliated with the state, that they're falling out with the state. Even then, there may still be strong links to state-based activity. And I want to linger on this example because when I talk about the fourth key dynamic about fragmentation and the interconnection in the global economic system, the picture I've got of Babak Zanjani here on the left is at the opening of a bus terminal in Tajikistan. Zanjani was able to build up a huge empire of property portfolio as well as transportation companies in Tajikistan because of the dynamics of that jurisdiction. And that's due to its own geopolitical positions and relationships. And that would obviously be very different from someone sitting in the US or the UK or many other jurisdictions globally. So what I want to imagine here is the practical scenario, which is that you are selling a high value property in Dubai or in London or in Abu Dhabi, and the buyer says that their wealth comes from transport infrastructure in Central Asia. My question is, would Iranian sanctions evasion immediately be the first thing that you think of? And I think certainly in my case, it would not be. And I think that is exactly the problem that we face. So finally, in my section, I'll wrap up by considering briefly how risk is evolving in the market now. So if we move forward to the next slide, I think the core message here is that illicit finance risk in real estate is evolving. So it's no longer just about someone buying a property in cash through a shell company at the point of transfer. That very much was the classic model. And cash purchases is something that many jurisdictions, many regulators around the world have really taken a lot of steps to improve the response to. But increasingly, we see that risk sits earlier and deeper in the transaction chain. So in the creation of ownership structures and pre-completion trading, and in the very payment architecture that's used to transfer value to be able to purchase property. So I think that the key things here, a key example is around off-plan and developer-led payments. So this is a really good example of how commercial innovation can overlap with a regulatory gap to create a risk vector at the same time as a very exciting commercial opportunity. So in the UK, for example, developer purchases are not subject to the same AML requirements as through property agents. So that clearly creates a situation in which assets can be purchased under substantially less scrutiny. And there are obviously good reasons for developers being able to sell off-plan properties, for pre-sale, exchange of contracts to further buyers. All of those things help create a really dynamic property market. And I think the message I want to leave on before I hand over to Finlay is that innovation commercially is incredibly important for continuing to stimulate property markets globally, but so is our resilience to illicit financial intervention. It's been through sort of a series of indexes that are published by JLL and LaSalle. It's been shown that markets which have more transparency and more resilience to illicit activity in their real estate sectors outperform other markets globally. So I think what I want to leave, where I want to leave my kind of macro discussion here is very much on that message that it's not only about the risk, but it's also about the potential reward that we can find from tackling various types of illicit activity more and more strongly. It's not necessarily easy. As I've shown in some of these examples, risk can be very deeply buried under many layers, but it yields incredibly fruitful broader rewards. So with that, Olivia, I think I'll hand over to you and Finlay.
Thanks so much, Henry. That was a fantastic summary to start off with. So Finlay, I believe, is now going to take us through a step-by-step, if you will, of how to launder money through property, which will be very instructive for any illicit actors joining us today. So take it away, Finlay.
Thank you for that introduction, Olivia. And yes, thank you to Henry for that sort of macro level why is property such a good asset to get if you want to launder. What I'd like to look a little bit more into is what if you have a big stash of cocaine money that you need to clean, what steps would you want to take to get that into a nice clean property? And then after that, I'm going to look at a couple of case studies and see how they further illuminate the sort of trends you can see on the micro level with laundering. So if we go on to the next slide, there should be, I've divided sort of the steps you'd want to take into 4 steps. So the first one, you'd want to establish opaque ownership. This is why if you look into records of London, there are so many properties, even small ones, owned by the British Virgin Islands. Now, that doesn't necessarily mean they are all ultimately connected back to some malicious moneymaker, but it is often the first sort of step used is to create these companies, bank accounts in places like British Virgin Islands, Isle of Man, because you can't directly be seen as the owner of a property. So secondly, once you have these sort of structures set up, the entities, you often need individuals, sort of lawyers, estate agents, financial advisors who can act on your behalf, act as your sort of proxy. These people are often not partaking in illegal activities themselves. They're often legitimate professionals, just acting as intermediaries. In a good sort of system, they might actually be kept separate from each other. So no one person is fully aware of their position as a proxy buyer within this network. However, sometimes they are a bit more connected to an individual. Often in more obvious cases and higher risk scenarios, family members are used as, the close associates they have buying these properties for them. Thirdly, once you have those two things set up, that's when you can start moving the money through these entities, these proxies. And in many of these case studies, they are moving them through 2, 3, maybe even 4 different jurisdictions before they finally get to acquiring a property in, say, London or New York. Again, all part of hiding where this money is originally coming from, reducing the chances that an investigator such as myself would find where it's coming from. And then finally, once all that money is being connected, they can begin to purchase their properties via third parties. So usually you're not going to list yourself. You're going to list a foreign registered company, nominee directors, an associated or a real buyer. See these being registered under alternative citizenships, so not people using their original country of origin. So on the next slide, we've lined up a few nice pictures of a variety of properties that have been used in cases. Top right, you'll see a mansion that's on Bishop's Avenue, London, colloquially referred to as Billionaires Row. However, despite this name, there is actually currently several properties laying dormant, and actually some, if you look on satellite imagery, being put into disrepair because there are several that are owned by an individual, were owned by an individual, Ali Ansari, who was found to be connected to the new Supreme Leader of Iran, Mojtaba Khamenei. You'll also see on the top left, that is a Mallorca villa, also owned by Ali Ansari's large network. On the bottom right, in Kensington Gardens, is a lovely flat with a great view of the Israeli embassy, again, owned via Ali Ansari's network and connected back to the new Khamenei. So it can happen anywhere. It can happen right behind the Israeli embassy. And then the final picture is connected to the next case I'd like to look at, which is the Shamkhani family. Now, the Shamkhani family, which on the next slide I have a sort of a handy Themis search map laying out, is Hussein Shamkhani and Abul Fazl Shamkhani are two sons of Ali Shamkhani, who himself was a senior Iranian political figure. And this is not just a case about property, but it's also large-scale sanctions evasion. And this is, I think, a prime example of how the property, as Henry was saying, is not necessarily the criminal part, but it is the end point of where you can nestle your money once you have done illegal activities or have circumvented sanctions. So Hussein Shamkhani himself has been under US and EU sanctions since 2005, and then more recently has been put under UK sanctions. This is because he is alleged to have orchestrated a network for generating over tens of billions of dollars through Iranian and Russian oil exports, and combining that with larger sanctions evasion networks. And his sons are also involved in this. But when they came to acquire London properties, they actually did so through these golden passports that we see as a theme. So they changed their names to Hugo Hayek and Sami Hayek with Dominican citizenship to further hide the acquisition. And they were buying things like large villas, gated communities, and these are the sorts of places that have low visibility, low transparency, and high value. So they are perfect for hiding the wealth of someone such as the Shamkhani family. So following on from that example, we have a few points that can sum up what are the sorts of higher risks in real estate transactions. And as you can see, they're quite similar to the steps I talked about earlier, use of shell companies, reliance of intermediaries. And as I said, with the Shamkhanis, when they're acquiring properties, it is most commonly large, bulk, high value, and new build properties, because these are ones that are, you don't have to take them over from someone else. You can buy multiple units at once. And they're only going to gain value, especially in places like Vauxhall in London. And again, as you saw with the Shamkhanis, the use of multiple citizenships, with the two brothers having their Dominican passports. But the important point is that as an investigator, one of these does not necessarily make a bad actor. I mean, plenty of people might use a bank to put away some of their funds, buy something through a lawyer. So having one of them doesn't make someone automatically connected to drug dealing or Iranian sanctions busting. However, when you take them all together, they're independent yellow flags that can build a broader picture and often are used as evidence that there is illicit financing going on. But these are all quite traditional examples. So we've also wanted to look at in the future how is technology, AI, the thing that's on everyone's mind right now, how is this also going to affect property and real estate laundering? So on the next slide, we'll see is first one, and a common one, is use of AI-generated identities and synthetic documentation is increasingly used by criminals to create realistic and fake identities, documents, deep fake verification materials. It can be done so much faster than it used to be. And just as an example, the US Treasury has just recently issued a formal alert noting that there has been a surge in such AI-generated documents being used to quickly bypass especially automated KYC systems, such as when you're required to put in a little image of an identity or something. AI can produce something very fast. And obviously there is a bit of an arms race for companies developing the systems to detect that, but it is something that is always evolving and seems to be continuing to be an issue. Secondly is crypto has become very popular for integrating illicit money. So if you move it through crypto assets, your sort of illegal laundered goods, laundered cash, crypto is great for this because of the blockchain. It's very opaque, and then it can be moved into fiat currency, and that itself can then be used to purchase properties. So an example of that has been the US authorities recently seized Bitcoin wallets from the Silk Road that had already been partially liquidated and invested through nominees and intermediaries into properties prior to them being seized. Number 3 is cross-chain and multi-layered crypto obfuscation before investing into property. This is quite similar to the last one. Advanced laundering can use cross-chain transfers, mixers, decentralized exchanges, and this can be used to obscure transaction trails even further. So once you embed that to the broader laundering scheme, it makes it very difficult to know where these funds are coming from and going to. And recently, prosecutors alleged that a company, Tornado Cash, had facilitated over $1 billion in laundered crypto. And much of this was also routed through multiple blockchains before integrating it into traditional economic investments. And finally, when you have these sorts of new technological developments, they start to converge with traditional typologies, as we looked at previously. So this has been noted by outlets such as the New York Times, who have investigated that anonymous shell companies buying Manhattan property are increasingly receiving their funds from crypto exchanges. So this is a classic example of blending the new and the old to launder money. So finally, I just wanted to look at a couple of real-world examples that incorporate some of the things we've been talking about. Number one is Su Jiangbo, I should say, who was previously referred to as Mr. X. And he was identified by an OCCRP investigation as having used a St. Kitts and Nevis passport, a golden passport, to launder, to acquire over 85 properties in London, valued at over $100 million. And this was all with funds earned through illegal gambling. Secondarily, there is Aliyev, who himself is not necessarily a criminal in the traditional sense, but he is that case of an autocratic leader with a large amount of oil wealth, who has invested, him, his family, and his inner circle have bought over $700 million worth of property in London. And in cases such as him, these properties can act as insurance. As Henry laid out earlier, they can accrue with income, they can create passive income. So if you are a leader who maybe is slightly paranoid about ever being overturned, they exist as a great sort of insurance. So, and then just finally, I wanted to show just how close to home this is. The pin on the left is the Themis London office, and the pin on the right is Triptych Bankside, which is a property that Su Jiangbo actually owns, or did own, before the government did a suspicious income order. So if it's happening in our backyard, it could happen in yours, and it's something that I think all sort of KYC industry must be very vigilant of looking into the future.
Thanks so much, Finlay. Literally on our doorstep. So you've seen the problem of financial crime in real estate and how some of it works in practice. And then in all good argumentative veins, we're going to now move on to what you can do about it. So I'm going to hand over to Melissa to talk about what real estate firms are kind of seeing right now from her experience as an MRLO, and then how they can protect themselves and how outsourcing can help as well.
Thank you, Olivia. So given the current regional landscape, I want to focus on something very practical. As Olivia has mentioned, how firms are adapting their compliance frameworks to manage sanctions and network-based risks. So if there's one thing firms should be doing right now, it's strengthening their ability to identify indirect sanctions exposure, because what we're seeing is a shift. Risk is no longer always direct. It's network-based, it's layered, and often hidden behind intermediaries. And in the UAE real estate sector, that risk is particularly relevant. So what are we seeing on the ground? In practice, most firms are not ignoring compliance. They are doing checks, screening at onboarding, basic customer due diligence, static risk assessments. Now, the challenge is that today's risks, particularly those linked to sanctions networks, are not always visible through these basic controls. So the real question becomes, would your current framework actually detect indirect exposure? So leading organizations are now focusing on network visibility, understanding not just who they're dealing with, but who they're connected to, who's ultimately benefiting from the transaction, and how funds are flowing through the transaction. And this is where beneficial ownership becomes so critical, because in many real estate transactions, particularly higher value deals, we see offshore entities, we see layered ownership structures, use of nominees, use of intermediaries. So These structures are not just for commercial reasons, sometimes they can be to obscure the ultimate beneficial owner. So identifying a shareholder is no longer enough. Firms need to interrogate ownership structures more deeply, especially where there are links to higher risk jurisdictions. Another area that's increasingly important is counterparty and ecosystem risk within the real estate space. So in real estate, a transaction is not just between one party. You've got buyers, you've got sellers, you've got brokers, agents, introducers, legal representatives, and third-party funders at times. So risk can sit anywhere in that chain. So firms are now moving towards a more holistic view, asking not just, is my client low risk, but also what does the entire transaction ecosystem look like? Alongside this, one of the most effective tools is simply to follow the money. So look at source of funds, look at whether it aligns with the client profile, the role of intermediaries, and movement of funds across jurisdictions. In higher risk scenarios, we often see layer transactions, third-party involvement, and inconsistencies that immediately don't add up. So these are areas where deeper scrutiny is required. So ultimately, effective compliance today is not just about joining the dots. Individually, a client, a counterparty, or a transaction may not raise immediate concern, but when viewed all together holistically, they can reveal patterns and connections that indicate potential exposure. And this is where firms are now hitting a practical challenge. It's not that they don't understand the requirements, it's just that implementing this level of depth, monitoring, interpretation consistently is very resource intensive, and it requires a lot of specialist expertise. Most firms don't fail because they ignore compliance. It's just that they simply struggle with sustaining this level of compliance and due diligence. So what we're seeing right now in the UAE real estate sector is a shift towards outsourced compliance functions, specifically to the outsourcing of the MLRO of the team. So why is outsourcing so popular? It's not to outsource responsibility, because that always remains within the business, but it's to strengthen capability. An outsource model allows firms to access specialist sanctions and AML expertise, implement more robust screening and monitoring frameworks, ensure independent oversight, and also to scale compliance in line with business activities. It's very dynamic, and it essentially bridges the gap between regulatory expectations and internal capacity, which is the leading problem that most firms face here. So when firms start considering outsourcing their compliance function, the key question we get is often, how do you actually implement this in practice? So from what we see in the UAE real estate sector, the most effective approach is very structured and straightforward. So step one starts with a gap assessment, understanding how your current compliance framework aligns with regulatory expectations and where the key weaknesses or blind spots are, particularly around sanctions, UBO visibility, and monitoring. Step two is to clearly define the scope of outsourcing. So this could include MLRO support, ongoing compliance advisory, sanctions and PEP screening, or even transaction monitoring and escalation support for the days you really need it. So it doesn't have to be an all or nothing approach. It's often phased based on business needs. Then comes integration, which is very critical because the outsourced compliance function should not sit separately. It needs to be embedded into your firm's day-to-day operations. So that onboarding, monitoring, escalation, all of these processes are very much aligned with the business. And finally, and most importantly, firms must maintain clear internal oversight and accountability, even when compliance functions are outsourced. So senior management remains accountable, the firm retains ownership of risk decisions, and there must be clear reporting lines and visibility over compliance activities that is performed. So regulators will always assess the firm's understanding and control of its risks, not the presence of an external provider. So essentially, to summarize, the nature of risk in real estate has changed in the last few years. It's more complex, it's more indirect, it's more dynamic. And if there's one priority right now, it's ensuring your business can identify and respond to that complexity effectively, because in this environment, not knowing is no longer a defense. Back over to you, Olivia.
Thanks so much, Melissa. So we're going to move into the last section of the webinar now before our Q&A. So do get some of your questions ready and start posting them in the Q&A if you'd like us to answer anything. But before that, I'm going to hand over to Paulina Sulewska and Alfida Alkan from our BD team. And they're going to talk through quickly the commercial perspective and what we're seeing on the ground in Bahrain in terms of the real estate sector as well.
Thanks very much, Olivia, and good afternoon, everyone. So my name is Paulina Sulewska. I represent Themis across the MENA region based here in the UAE. So I thought this would be a good opportunity to introduce some of the work that Themis is currently doing to support organizations across the region. We're currently working with one of the prominent states in the UAE to enhance due diligence and onboarding for ultra high net worth and high net worth individuals investing in the real estate sector. Now, the focus is straightforward: enable seamless, low-friction investment while fully aligning with the UAE's AML and financial crime compliance mandate. Now, for regulators, developers, brokers, and agents alike, the challenge is the same. How do you maintain strong controls without slowing down transactions? Now, real estate remains a key area of exposure for financial crime, particularly around money laundering, complex ownership structures, and sanctions evasion. Our role is to address that risk directly without disrupting deal flow through our AI-driven tools and on-the-ground team expertise. Now, alongside this, we publish conflict advisory notes as part of our conflict advisory series, helping firms navigate fast-moving geopolitical risk. And because the reality is this, the conflict reshaping the Middle East is rapidly redrawing the risk landscape. And this is precisely what bad actors exploit. Now, understanding your exposure is no longer just compliance, it's business critical. And our latest real estate conflict advisory note highlights how property markets are being used not just to store wealth, but as part of wider networks supporting regime financing. Now, I'd be very happy to connect after the webinar to discuss anything that's been spoken about today and also how Themis can further support you for our expertise. But with that, I'll hand over to my colleague Alfida, who will walk us through the current landscape in Bahrain. Thank you.
Thank you very much, Paulina. Hi, everyone. I'm Alfida Alkan. I'm based here in Bahrain, mainly supporting the real estate clients with strengthening their financial crime compliance frameworks. To add to what Paulina has said, what we're seeing right now is a clear shift. Real estate still remains a high-risk sector for financial crime, but with the FAT of 2026 approaching and the increasing real estate regulatory authority expectations, compliance is no longer just a requirement. It has become a business-critical function. The challenge that I see across most firms today is that teams are expected to move very quickly, but they still have to carry out deep defensible due diligence. And where I typically support clients is helping them streamline that entire process through bringing everything into one place, giving them a clear view of who they're dealing with, and making sure that risks are flagged early, whether they are sanction exposure, whether it's adverse media or complex ownership structures. But most importantly, it's not just about onboarding, it's about ongoing monitoring as well. So firms are not exposed after the deal is completed. And with that, the outcome is faster onboarding, stronger compliance, and more confident decision-making. And to finalize it, ultimately, that's what's going to matter the most, protecting your reputation, building trust, and enabling the sustainable growth in the Bahrain real estate market.
Thanks very much, Alfida. So we'll move into the Q&A section now. We've got a good 15 minutes, and I can see a few that have come in already. So Finley, I believe this one might be best answered by you. Why are sanctioned individuals and their families particularly drawn to real estate over other asset classes?
Sorry, that's quite a good question. So I think real estate has always been a very safe investment, whether it's because you were sanctioned or not. So as I said earlier, it can often act as insurance, especially if your position in being sanctioned is because maybe you are within the higher levels of regime, and regimes always fear being toppled. So it can exist as a good insurance in that sense. But more specifically relating to sanctioned individuals, many jurisdictions, I think, offer opacity in ownership. They can be held through companies, trust, nominees, so it can make it very hard to identify who is actually owning properties. And again, that is perfect, especially if you own property in the country that's actually sanctioning you. They often take less immediate scrutiny than a comparative company or other financial institutions might. So it's easier to sit there. In a lot of examples and jurisdictions, there's less due diligence and transparency standards around real estate compared, again, to a comparative asset such as a company. And because they are quite stationary, very stable, they're really suitable for cross-border management. So, if you have put all your money into a restaurant or a casino or something like that in America or Britain, and you are incapable of getting there, you're stuck in, let's say, Vladivostok, then, it's very hard to manage that remotely, even now. Whereas a property, it manages itself. There's very little direct intervention needed. So I think that's another reason it suits. And often they're very nice and glitzy and pretty is one last good reason.
The best reason of all. Thank you, Finlay. So this one looks like it would be a good practical one for Melissa. What would a best-in-class real estate firm be doing differently today compared to the average firm?
That's a good question. So a best-in-class real estate firm would go beyond basic onboarding checks. So they would look at risk holistically. They would focus on who is behind the client, the ultimate beneficial owners, who else is involved in the transactions, all of the intermediaries, how funds are moving, and not whether a name clears screening in the screening tool. So it's a lot more beyond the screening element of things. They would also move from one-time checks to ongoing monitoring, which is dynamic, recognizing that risk factors and risk profile evolves over time. Another key difference is judgment over tools. So they don't rely solely on screening tools or risk assessment tools. They interpret connections, patterns, and indirect exposure on the back of it. Importantly, they treat compliance as a business critical function, not as a business blocker, but rather a business enabler. So not just a regulatory requirement. And in practice, many are combining internal ownership with external expertise, which is outsourcing, to manage this level of complexity effectively. So I feel like all of these points are the recipe for having a best-in-class real estate firm that is in the best books of the regulator, best books of their clients, partners, and all other stakeholders.
Fantastic. Thanks, Melissa. Okay, Henry, I think this one touched on what you were talking about. So a lot of the structures you described, special purpose vehicles, investment vehicles, offshore entities, complex ownership chains, are also perfectly normal in commercial real estate. So what should firms actually do in practice without treating every complex deal as suspicious? It's a very good question.
Yeah, well, I think the answer is obviously that complexity is not necessarily the same thing as criminality, and that the point is not to treat every offshore structure, every SPV as, well, obviously there's some kind of money laundering or sanctions evasion going on here behind the scenes, but it's rather to recognise that that complexity makes it harder to understand, to rely on kind of your understanding of what was happening in that transaction. So, for example, as Finlay was alluding to, certain jurisdictions and certain types of structures can make it very difficult to actually ascertain who kind of the owner of that structure is. So I think the point there is that then, understanding that, it's really essential to take a risk-based approach. So if you're dealing with a type of transaction that is inherently more difficult to interpret quickly, then you probably need to take depending on your firm's existing approach to dealing with risk, you probably need to take a more advanced approach to understanding that transaction. So that's exactly the type of situation in which Finley's team or maybe our team would be called in to sort of give some advisory on how what is the actual underlying reason for this structure happening? What is the underlying reason for this corporate network? Is this legitimate? Is this as the client or my counterparty is claiming it is, or is there actually perhaps something else going on here? And so that will often depend on kind of a really solid understanding of the actual kind of case, so the jurisdictions that are involved, the types of business that are involved, the types of actors that are involved. And we see frequently we will do a check like that and it will be entirely legitimate. It will be that complex transaction or that complex structure will simply be reflective of historical evolution in a corporate structure, a combination of different commercial needs, sort of tax optimization or a need to accommodate business partners in different jurisdictions. But there are cases that we see where there is hidden risk and it's undetectable because of the use of, let's say, a particular trust structure in a particular jurisdiction. So I think the important thing is, and my message here is that our approach to risk has to become more advanced and more nuanced, rather than saying we're just not going to deal with any complex transactions. That clearly would not be productive, and it is not a good response, even if the mission is to really combat financial crime. I think instead, both for a kind of anti-financial crime perspective, but also from a commercial perspective, the call is to do better, more intelligent checks using better technology and better expertise, and bringing that in to understand situations that you're not familiar with when that is required.
Thanks, Henry. So I can see two questions that lead on quite nicely from that, and maybe I'll start with you, Finley. And if Henry's already said everything, then feel free to just pass this one. But when conducting a due diligence report, what data points would immediately elevate such cases to high risk? I'm afraid to say you're on mute, Finley. So.
My apologies. Clearly very professional, but I think you made a good point with introducing that question. Is a lot of what Henry was just talking about, I think, relates to trying to identify these things, is that complexity can be a sign, but it is not always a sign. We cannot initially judge someone to necessarily be connected to illicit financing just because they have quite an opaque or a complex financial network behind them. So when we do sort of due diligence reports on someone that we suspect might be connected to either illegal funds, sanctioned state funds, it is that sort of thing about taking all the different clues, all the different nodes into consideration to try and understand a wider picture of what someone is involved with. So there's obvious ones such as the things we use in our reports as that we evaluate for red flags, such as, are they connected to a lot of state enterprises? Are they politically exposed in any significant way? Are they connected to any sanctioned companies? Is there any disparity between their reported income and the sort of properties that they might be connected to? As I say, I think it's just all of these things need to be taken into consideration, evaluated on a case-by-case basis, which is what makes it so hard when we have new capabilities like AI that can produce sort of fake identification so fast. It is sort of that battle between thoroughness and efficiency that I think a company like ours and many is really trying to parse out. So yes, I guess my ultimate answer is it's quite complicated.
Well, that segues very neatly into the next question, actually, which I think maybe Alfredar, I'll put to you. So in a practical sense, how can real estate firms balance strong due diligence with the need to move quickly in business operations, as Finley was alluding to?
Yeah, well, really, that's a great question because that's really the core challenge. Because business teams, they want to move quickly, but compliance teams, they want depth and accuracy. Traditionally, due diligence has been quite manual, which creates the delays and sometimes inconsistencies in how risk is assessed. But the shift now is towards using technology to standardize and automate a big part of this process, whether that is screening, whether it's ongoing monitoring, or identifying the ownership structures, which allows the firms to get faster insights without having to compromise on quality. So that makes the compliance to become an enabler of the business rather than a bottleneck for the operations. Ultimately, it's about creating a process that is both efficient and meeting the regulatory requirements from a regulatory perspective.
Amazing, thanks very much. So I'm going to probably throw out the last question here to all, a bit of a wild card to all of our panelists. If anyone would like to answer it, does Trump know that the Iranians are his next door neighbours in New York? I think the answer is probably nobody knows at any point what Trump does know or does think or doesn't know. Would anyone like to have a stab at that? Henry, you've unmuted yourself.
Well, I think maybe all I'd say is that if you want, you know, a nice optimistic property evaluation when you're moving house or selling your office building, I think, you know, you could do worse than the current president of the United States for your valuation. I think that in terms of actually answering the question, it's been a really long running case, and it's one of the interesting things is how difficult it was to actually come to a kind of legal seizure. And I think it shows one of the things that's really important here is that actually preventing the entry of funds into the property market is really crucial, because once they're there, once you know, real estate assets are owned by actors that you, from your perspective, are illicit, it can be very difficult to get them back. That case now has pretty much run its course, but it took, you know, about 2 decades to pass through. So I think it's a really important thing when you're considering kind of the long-term nature of risks that you can face if you, for example, as an entity, become embroiled in a long-running litigation brought by the state. So I think that's worth highlighting.
Very expertly navigated. Thanks very much, Henry. I think we will draw it to a close there with 2 minutes to spare. So thank you so much to all of our panelists. I've really enjoyed moderating this session. I think you gave some fantastic information there, and also to our audience for all those fantastic questions too. I'm sorry that we didn't get through all of them, but there were a lot, and it's good to keep on time with these things and not overrun too much. So I think, you know, what we've explored today is really a reminder that real estate financial crime doesn't exist in a vacuum. And I think Iran really showcases that the broader sanctions evasion ecosystem around it. It does show us that property markets are still one of the most attractive destinations for illicit capital, particularly when other routes close down. And it does really show us as well that these risks that we're managing in this sector are very much geopolitical, and they're shaped by conflict and sanctions regimes, but also the decisions that are made in Washington and Brussels, London, beyond elsewhere, and by the networks that do exist that are specifically to circumvent those decisions. So, you know, when ownership structures do span multiple jurisdictions, and we've got sanctions lists changing and geopolitical flashpoints sort of shifting overnight, then we do really require, as we've heard today, the right tools to sort of surface what the paperwork doesn't show you, but also the right intelligence to understand that kind of in context and what you're actually looking at when you do get that information. Because having a name on a register is one thing, but understanding really what that name kind of connects to and why that matters right now is something else entirely. So thank you so much for your time and attention and engagement today. These are, complex issues, and they're not necessarily easy to solve, but the fact that you're here and wanting to learn more and asking good questions is itself part of the solution. So thank you very much for that, and I hope that you have found it informative and instructive, and I hope that you enjoy the rest of your day. So thank you very much once again for joining us.